Hello everyone, my name is Clément Gignac, Chief Economist for IA Financial Group. So over the next 5 to 7 minutes, I will try to summarize the webinar that we had just recorded for our financial advisor. So this month, the title of my webinar is Economy and Capital Markets, a Tug of War on Wall Street. Tug of war because the market is so much influenced by all the news, the development, even the tweet from Mr. Trump regarding the negotiation with China or other geopolitical development. In fact, over the last 25, 30 years of my experience, this is the first time I see that geopolitical development have so much importance and influence on Wall Street. Of course, if you're back 30 years ago, for example, 40 years ago, when we have this Cold War tension between Russia and US, it was less important for Wall Street. Reason? Because the trade between Russia and US, for example, 30 years ago, was only $2 billion per year. That represents less than 1% of the total trade of U.S. These days, the trade, in fact, volume between U.S. and China is very important. So the trade represents $2 billion, not per year, $2 billion per day. So that represents close to 15% of all U.S. trade. So the fact that we have tension with tariff and threat to additional tariff, of course, that influences the economy. So for the companies and for business, for Wall Street, for example, corporate America, this is uncertainty. So that's the reason that we have a very low capex, and even on the export being affected. Disturbing enough, this is the first time that we see that outside recession. The trade volume worldwide has shrunk in the last 3 quarters. This is the first that we see 3 quarters in a row, a decline of trade volume outside recession period. So that tells you something. So that's the reason that we do not talk about GDP recession, but we talk about manufacturing recession in many countries. For example, in Germany, and even in US, if you check the last ISM or PMI, it's very weak. So that tells us something. So any hope, anything optimistic here or game changers on the horizon? The answer is yes. Let's start with this China negotiation with US. I have noticed that Mr. Trump become more flexible recently. He knows probably that never a US president has been re-elected if you have a recession or if you have a bear market. So clearly, he starts to realize that it will be a long shot with China, and probably better not to have additional tariff, because if you go with additional tariff, you will affect the consumer confidence and you could create a recession and it will not be re-elected. So this is interesting. So on that level, I don't want to be complacent, but clearly I assume that you will have more positive development, even if it will take much more time than we thought initially. On Brexit, for example, this is a breaking news this morning that the Premier of UK, Mr. Johnson, have a deal with EU. So it needs to be ratified by the UK Parliament, but at least we seem to moving in the right direction. In fact, the euro has appreciated on the news. Other positive development, central banks is no longer restrictive. You can notice over the last few months, many central banks now go with rate cuts. So using the past as a guide, they have some transmission lag, but when central banks shift from restrictive to neutral or even more accommodative, usually with 6 to 12 months lag, you see the reacceleration of the world economy. So bottom line, on the big picture, so no complacency. No, we have made no mistake. We have a deceleration in the worldwide economy. The IMF now predict 3% growth. It's no longer 2.54, but the recession probability remains still very low. So we talk about maybe 30%, no more than that. In Canada, the economy remains very resilient. Job creation are very strong. This is the strongest sequence ever seen in 17 years, and that explains why Bank of Canada is very reluctant to rate cut and join the Fed rate cut, because the no necessity to cut rate in Canada, partially in the fact since the inflation are in target around 2%. Capital market, I mentioned at the beginning, so this is a tug of war. We have good news because rate cut could stimulate the economy, and usually rate cuts are very well received, in fact, for Wall Street, and that helps for the P. But we have headwind, okay, not only tailwind, but we have headwind. Notice we are right now in the earnings season. That sounds that we can have earnings recession. So we have this fact that overseas companies are affected by the slowdown overseas. So clearly we have some headwind. This month we have the privilege to have my colleague, colleague, Jean-Pierre Chevalier, who is the portfolio manager of U.S. equities, he pointed out that we are in the sixth industrial revolution with intelligent technology. So that could help to maintain the bull market. Clearly, he invites us not to analyze only with the traditional fashion, with price earning, this kind of things. He suggests to analyze price cash flow. And if you go with that angle, price cash flow, clearly this market is still undervalued. So they have still upside on that. In addition, he pointed out that the people are very scary, very pessimistic. We have a lot of cash on the sideline. Usually, this is a good recipe for a nice rally. So bottom line, we think that we still have some potential on the market. In our strategy, we recommend, in fact, to buy on weakness, to maintain buy the dips strategy, and we recommend overweight stock. We like very much the banks. Keep in mind the banks have a high dividend yield and they exceed the 10-year maturity bond, so it's interesting. In NAR, this is our view. Having said that, we always invest, since each of us are different time horizon, our risk tolerance is different, so that you have to consult your financial advisor, and we are there to help you at IA. So on that note, thank you and have a good day.